Welcome to Market Brief, After Hours. It was quite a day on Wall Street, with markets stepping back from record territory. We saw a sharp rotation out of software stocks, a renewed surge in oil prices, and geopolitical tensions flaring up once again in the Persian Gulf. To break it all down, let's start with the big picture. What exactly drove the retreat today after those early record highs?
It was a classic risk-off pivot. Early in the session, optimism had actually pushed major indices to fresh intraday highs, but that sentiment is incredibly fragile right now. We have a very tense situation between the United States and Iran, specifically involving naval maneuvers and shipping disruptions in the Strait of Hormuz. When you combine that geopolitical uncertainty with disappointing reactions to major tech earnings, investors simply decided to take some chips off the table.
Let's look at the specific numbers for the major U.S. indices. They all took a hit, but tech really led the way down.
That's right. The Dow Jones Industrial Average extended its pullback, dropping 0.36% to close at 49,310. The S&P 500 also retreated after touching a new all-time intraday high earlier in the day. It fell 0.41% to close at 7,108. But the heaviest damage was in the tech-heavy Nasdaq composite, which slid 0.89% to finish at 24,439.
And that Nasdaq drop was primarily driven by software names, correct?
Exactly. We saw heavy losses from major players like Microsoft, Palantir, and Oracle. The broader software ETF was under significant pressure today as well. It completely offset some of the sector strength we saw earlier in the week.
Moving across the Atlantic, European markets seemed a bit more mixed. How did things play out over there?
Mixed is the perfect word. The Pan-European Stoxx 600 managed to edge up by 0.1%. But looking at individual countries, the story diverges. In the UK, the FTSE 100 slipped by 11 points, or 0.1%, to finish at 10,466. Germany's DAX also fell, dropping 39 points, or 0.16%, to 24,155. But then you have France and Switzerland outperforming. France's CAC 40 gained an impressive 1.13% to reach 8,249, and Switzerland's SMI surged 1.38% to end at 13,248.
Why such a divergence across the European region?
A lot of it comes down to economic data, specifically the Purchasing Managers Index, or PMI. The Eurozone's manufacturing PMI hit 52.2 in April, its best level since May 2022. However, Germany's composite PMI fell sharply to 48.3, completely missing expectations. France had a drop in its composite PMI to 47.6, but showed great resilience in manufacturing. Meanwhile, the UK saw both services and manufacturing PMIs exceed forecasts, printing at 52 and 53.6 respectively, showing robust expansion. It's a very fragmented economic picture.
And what about Asian markets? Geopolitics seemed to play a massive role there today.
They certainly did. Markets across Asia largely finished in the red, reversing earlier gains. This happened right after reports emerged that the US military had intercepted 3 Iranian oil tankers. That immediately heightened geopolitical fears. Japan's Nikkei 225 ended 0.75% lower, despite hitting an intraday record of 60,013 earlier in the session. Chinese markets struggled too, with the CSI 300 slipping 0.28% and Hong Kong's Hang Seng declining 0.92%. India's markets also took a hit, with the BSE Sensex falling 1.09% and the Nifty 50 dropping 0.84%. The only real bright spot was South Korea's Kospi, which managed a 0.90% gain, supported by stronger than expected GDP growth.
Naturally, those tanker interceptions had a direct impact on the energy sector. Oil prices surged above some key levels.
Brent crude jumped about 3% to settle at $105.07 per barrel, and WTI climbed to $95.85. The fear of supply disruption is palpable right now, with both the US and Iran trying to enforce competing controls over shipping routes. And of course, surging energy prices immediately reignite inflation concerns, which puts pressure on risk assets and drives up Treasury yields. The 10-year yield moved up to 4.325% today, while the 2-year rose to 3.832% and the 30-year climbed to 4.919%.
That inflation puzzle is definitely something we'll need to keep a close eye on. We're going to take a quick break, but when we come back, we'll dive into the Forex markets, look at some crucial moving averages, and break down today's biggest market movers. Stay tuned. Welcome back to Market Brief, After Hours. Before the break, we discussed the broader indices and geopolitical tensions. Now, let's get into the currency markets. It looks like momentum is shifting across several major pairs. Let's start with the euro to US dollar.
Euro USD had an interesting session. It closed down 0.16% at 1.1686. Right now, price action is heavily compressed within a tight moving average cluster. The pair is holding below the 100-day simple moving average, which sits at 1.1705. However, it's finding support near the 200-day SMA at 1.1674 and the 50-day SMA at 1.1659. Because it recently got rejected from levels above 1.1800, short-term momentum has shifted lower. The bulls have lost control following that early April rally.
What about the British pound? Did GBP USD see a similar pullback?
It did. GBP USD finished down 0.26% at 1.3468. It is currently testing its 100-day SMA at 1.3457. The good news for the pound is that it's still trading above both the 50-day and 200-day SMAs, which are both hovering near 1.3414. That keeps the broader structure supported, but recent gains have definitely stalled just below the 1.3580 peak, indicating that momentum is cooling off after a multi-week advance.
The Australian dollar also seemed to hit a wall today.
Yes, AUD USD closed down 0.36% at 0.7133. The pair is still in an overall uptrend, supported by rising moving averages. The 50-day is at 0.7047, the 100-day is at 0.6912, and the 200-day is all the way down at 0.6722. But today's session showed a clear pause in momentum as the price encountered resistance near the 0.7166 level, right as it approaches that key 0.7200 region.
And finally, in the Forex space, the US dollar to Japanese yen pair continues its march upward.
USD JPY is incredibly strong right now. It closed up 0.16% at 159.68. It is trading well above its major moving averages. The 50-day is at 157.99, the 100-day at 157.07, and the 200-day at 153.66. This reinforces a very strong bullish trend. The price is now approaching a massive psychological barrier at 160.00. If we see a sustained break through 160, the uptrend will likely continue. If it gets rejected, we might see a period of consolidation.
Before we move on to individual stocks, we should also touch on the precious metals market. Gold and silver both took a hit today.
They did. Gold faced significant selling pressure, falling 1.03% to close at $4,695. It actually reached an intraday high of $4,753, but couldn't sustain it. Technically, gold is now trading below its 50-day SMA of $4,876 and its 100-day SMA of $4,723, which shows a loss of medium-term momentum. However, it is still sitting comfortably above its 200-day SMA of $4,219.
And silver saw an even steeper decline, right?
Much steeper. Silver slid 2.83% to close at $75.54. Bearish momentum is really building there. The price fell below both the 50-day SMA at $78.74 and the 100-day SMA at $78.27. Like gold, it is holding above its 200-day moving average, which is way down at $61.08. But the chart is looking vulnerable. It repeatedly failed to sustain gains above the $80 level, leaving it open to a further unwind in the near term.
Let's bring it back to the domestic economy for a moment. We received some new data on the labor market and business activity today. How are those looking amidst all this global uncertainty?
The domestic data is actually quite resilient. Initial jobless claims did edge higher, rising by 6,000 to 214,000 for the week ending April 18th, which was slightly above expectations. But continuing claims remain well below last year's average levels. We also saw claims from federal employees fall, which eases concerns about government layoffs. Overall, the labor market remains incredibly firm, with very limited signs of widespread job losses.
And the PMI data reflected that strength as well?
Absolutely. S&P Global's flash PMI data beat expectations. The manufacturing PMI rose to 54.0, marking its strongest level since May 2022. The services PMI also indicated continued expansion, coming in at 51.3. Both production and new orders reached multi-year highs. So the underlying U.S. economy is still humming along nicely.
Let's pivot to individual stocks. Earnings season always brings some wild swings, and today was no exception. Texas Instruments had a massive day.
Massive is an understatement. Shares of Texas Instruments soared 19% today. The semiconductor firm significantly exceeded the analyst consensus of $1.57 for their earnings. It's a very strong signal for earnings growth in that space.
United Rentals also had a stellar session, jumping even higher than Texas Instruments.
Right, United Rentals jumped an incredible 23%. The equipment rental giant raised its full-year sales guidance to a range of $16.9 billion to $17.4 billion, and the market rewarded them handsomely for that optimism. We also saw Penn Entertainment rally 16% after their first quarter results handily surpassed market expectations.
But it wasn't all green screens for individual companies. WEX and Lululemon both took significant hits. What happened there?
With WEX, it's a governance issue. The payment processing company saw its stock tumble 16% amid a bitter boardroom dispute. The firm is actively urging shareholders to reject nominees proposed by an activist investor who wants to replace a third of the board. Markets hate uncertainty, and boardroom brawls provide exactly that. As for Lululemon, their stock fell more than 13% following a major leadership announcement.
It really is a complex environment right now. On one hand, we have strong domestic economic indicators, like the US Manufacturing PMI hitting a multi-year high, and a firm labor market. But on the other hand, we have this intense geopolitical instability in the Middle East, threatening energy prices and inflation.
That's the tug of war we are witnessing. The resilience of the U.S. consumer and manufacturing sectors provides a solid fundamental floor for the markets. However, the threat of an escalating naval conflict in the Strait of Hormuz is a massive risk factor. Moving forward, the focus is going to remain squarely on corporate guidance and any further developments in the Middle East. That will determine whether today's retreat is just a healthy consolidation phase or the beginning of a much broader market correction.
It's certainly a situation that requires close monitoring in the days and weeks ahead. Thank you for tuning in to today's breakdown of the markets. If you find this useful, please follow Market Brief after hours.